Hello and welcome to this episode of Akrinos Access. I'm Eric Matei, sitting down with the one and only Evon Mendrin. Evon, as we've all come to know Evon, is the principal and founder of Optometry Wealth Advisors. We are grateful to have Evon join us on this episode of Akrinos Access as we're going to unpack the top 5 financial questions that Evon is getting from optometrists that are looking to cold start or purchase a practice. Y'all, this is going to be a jam-packed episode full of great financial insights. So be sure to listen carefully. And well, Evon, what do you say we go ahead and jump into it, man? Welcome to Akrinos Access.
I appreciate it, Eric. I am always excited to be here. Thank you again for having me. Let's dive on in.
Let's do it. And, to kick things off, I would love for you to just share with our listeners a little bit about, your background and particularly your journey and get into financial advisory and wealth planning with optometrists.
Yeah. I mean, I've been practicing as a financial planner for, I think this is year 11 now. Cold started this financial planning firm, I think about 4 years ago now. And from the beginning, we have been focused on helping optometrists, especially those that own your own private practice, and helping them to navigate all of these fun financial puzzles you have to solve with being not only a professional with high student loan debt, but also a business owner and trying to juggle all these important things that are going on in your life. Yeah,
absolutely. And, Evon, remarkable work that you do. And we get the opportunity to work together in a few occasions, and just really, really incredible value that you bring, and particularly on this front of wealth planning. So on that note, let's kind of like jump into this conversation and maybe start by just defining wealth planning.
Yeah. What is wealth planning or financial planning, whatever sort of title you want to put on it? It's taking your income and your resources, assets, whatever those may be, and planning for the things that you want to happen in your life, and plan against the risks that can happen in life that can derail all that. So as we go through life, we usually have things we want to prepare for and plan for and aim for. Buying a practice, cold starting a practice, growing a family, living a certain lifestyles, having vacations, saving for financial independence, for college, whatever it is. There's things in life we want to aim towards. And so we can look at the income we have and the resources we have and make as the best decisions we can on an ongoing basis as we aim for those things. And then for those big risks that can come up, things like death and disability and big medical expenses, things like that, we can plan against them and do the best we can there. That's essentially what financial planning is and wealth planning. It's taking all the stuff we have and the income we have and on an ongoing manner, making the best decisions we can.
And in the context of that, we then get to exploring a variety of different savings, investment vehicles. Obviously, I know perhaps we'll touch on loan repayment, I think, in the context of our conversation today, right? So payoff strategies, right? So it's the whole enchilada, if you will, of personal finance, personal wealth, and obviously in the context of today's conversation, exploring it through the lens of those entrepreneurs amongst optometry that are looking to cold start or purchase their practice.
That's right. Yep.
So Evon, let's go ahead and jump into question number 1. And by the way, maybe it should be said, are these in rank order, or are we just kind of doing these in a grab bag?
These are just, there's no sense of rank or order. It's just, these are some of the things that came to mind. And maybe we'll, one of the things, the very first question I'll touch on maybe is foundational, and then the others kind of build upon it. And so the first question that I talk to and that optometrists will ask me as they are either planning to cold start or planning to purchase is, how do we make the cash flow work? Some variation of that. Because as you're going to cold start a practice, there is this cash flow puzzle. You're entering a relatively uncertain time. Very often you are leaving a full-time job. Maybe you're associating part-time in some places, but you're leaving the comfort of a full-time job. You're working with a team like Akrinos to plan out the cold start. Sometimes the build out goes longer than expected. The revenue in the early years aren't as substantial enough to pay a full income. And so there's a lot, there can be a lot of uncertainty with cash flow in the practice in these early years. And so, how do you give your business, your practice, a long enough runway to get it off the ground and successful? Well, you have to make sure that your household expenses can be paid for these first 2 to 3 years. You have to know that your personal expenses are covered, so you don't have to dip into the practice. And so there's this sort of puzzle to figure out, okay, we have maybe some sources of income. Maybe your spouse is working, maybe not. Maybe you're single and you're associating part-time. What income do we have coming in? What are our living expenses for a reasonable lifestyle? And how do we make the cash flow work so that we can go these 2 to 3 years, put food on the table, keep the lights on, and give your business a long enough runway to get off the ground and be successful? And that's from the cold start perspective. From the purchase perspective, it's a little bit different. You're buying an asset, and you need to know that this business you're buying is going to have enough collected revenue as you go through that due diligence, is going to have enough collected revenue to cover the operating expenses of the business, cover debt service for buying the practice, and be able to pay your family enough to have a livable lifestyle. And so from a cash flow perspective, when purchasing, it's really, part of that due diligence is figuring out, is this practice collecting enough revenue based on the expenses to give your family a lifestyle you're looking for? And how does that change over time as the cash flow improves?
Yeah. And I think it's important to point out here, Evon, a couple of things. One, that whether cold starting or purchasing, when we do have third-party financing involved, right? Like if a bank is involved, it's going to be loaning those dollars, right? We know that they build into this. They're not setting you up for failure, right?
Yeah.
So number one, consider that there are a lot of, whether it's, folks working with you, Evon, folks working with our team over at Akrinos, what have you. There are a lot of stakeholders that are looking at through a lot of different lenses in that role of the bank, right? They're not in the business of lending money out and not seeing that money be paid off. But not only that, consider they not only want to see you survive, they want to see you thrive, right? Because in their view, the more business you do is more banking that you're going to do with other functions of their business. Where I'm going with all of this is that from a financial modeling standpoint, and Evon, I'd love to get your take on this as well. It seems that oftentimes the numbers can make sense, but I think sometimes folks may be perhaps accustomed to a lifestyle that, at least for a portion of time, cannot be sustained, right? Particularly when you're stepping away from that full-time income to now a portion of that time is going to be in the fledgling cold start, or even in that practice purchase. I mean, we need to be sure that things still can continue to cash flow so that we can meet the debt service. But what's your take as observations you've made?
Yeah, I mean, that's a great point on the lending. Is you are going to need to qualify unless you're buying and there's seller financing available. The seller is willing to finance that. But if you're going to bank to get some lending, you're going to need to show that the cash flow in your personal life and what the business is creating is enough for them to get their payments, right? They need to know that there's going to be enough cash flow for them to get their money back. So qualifying for lending is a big part of that. And you're absolutely right. I mean, everything's about trade-offs. Like all of these decisions are about trade-offs. And if you are accustomed to a certain lifestyle and you are just not willing to adjust that in order for a cold start or purchase to work out, well, then the trade-off you are preferring is to maintain the lifestyle. So maybe the practice just isn't the right decision for your family. I mean, sometimes that's just the case. But if the practice is the priority and that's the trade-off you're willing to accept, well, then you have to be willing to create more flexibility in your personal spending. And I've had some decisions where they couldn't, like they trimmed everything down where they could. One conversation I had recently is someone that, I mean, their build out literally went longer than expected. They ate through a lot of the funding they had earlier than expected. And we were just kind of trying to brainstorm like how to create more wiggle room to give them more of a longer runway. And so sometimes just tough decisions have to be made. And these are all just matters of trade-offs and which ones you're willing to take. And as a part of this conversation around cash flow, it's often coming to the discussion around student loans and what do you do with student loans? And this varies depending on what stage in the career you're in. But if you're in the earlier portion of your career, you likely have 100, 200, sometimes $300,000 of student loans. And so that's going to play a really big part in your household cash flow to cover the bills as well as qualifying for lending. And so we have to make some decisions there. We have to say, okay, in the short term, what is the best way to handle things like student loans to create the most wiggle room in your cash flow to get you into ownership, because ownership's the priority here. And then long term, what is the best route to take with these student loans? And those can be two separate decisions, but we need to make that decision too, because student loans can be a huge weight on cash flow. But there's ways to work around that.
Yeah, absolutely. So item number one, again, in no particular order, right, Evon? This is no rank order. We're basically just touching on 5 hot financial questions for optometrists looking to jump into cold start purchasing a practice. Number one is cash flow. And here, y'all, we are talking about household cash flow. How are you going to pay the bills, put food on the table? Absolutely. I think it's also important to note, Evon, that you served it up that, hey, if the time is not right, then the time is not right. And I think that's something that we can all, Evon, as you've, launched, and I don't know if everybody caught that when we were making the intros, like you've been in financial planning for 11 years. Hey, you cold started Optometry Wealth 4 years ago, similar to Akrinos. Had some wonderful corporate jobs over my career before getting this vision to go into entrepreneurship. So it's really important that you understand your household finances and you're making decisions that's going to honor that. And certainly if your family's involved, it's one thing if you're a party of one, but if you have a family, to be ensure that everybody's going to be taken care of. So it's not oh my gosh, mom or dad started this business and now it's all reign of terror. So good stuff, Evon. So item number one, cash flow, right? Yeah. And certainly the role of student loans in that. Which, by the way, y'all, side note, if you carry student loans, no matter how much, and you have not connected with Evon, absolutely, he is, I believe you're one of only a couple of certified student loan specialists that I know of that are really hunkered down in this optometry space. So definitely worth an evaluation.
Yeah, reach out. I mean, this is my specialty here, right? It's how do we make decisions around student loans along with all these other goals that you're planning for. And the second question that comes up, which is related to cash flow, it's how do we plan around health insurance? And very often, again, if you're leaving a full-time job, if you're single, often you may be losing, especially if you're with a larger corporate employer, you may be losing the health insurance. So now you have to make some decisions. Sure. It becomes much more important, as you mentioned, Eric, if you have a family now, you have a wife, you have kids. If your wife or if your husband doesn't have access to a healthcare plan at work, then you have to make some decisions. Okay, how do we get healthcare? And very often you're going to these healthcare marketplaces in each state. So you're very often going to find a healthcare marketplace plan. And there's different types of plan. I mean, the first thing you really want to think about is what makes sense for the family from a healthcare consumption perspective, meaning what are the healthcare needs of your family? Are there consistent medications or doctor visits that due to specific healthcare needs, or is it just preventative stuff and you really don't go to the doctors that much outside of that? So the healthcare needs of the family is going to play a part of that. But one really important aspect of that are the healthcare premium tax credit subsidies. So if you buy a marketplace plan on the exchange, and you don't have access to another plan, like through a spouse at work, then you can qualify for these healthcare premium subsidies, essentially. They're tax credits, but you can get them up front and they can offset the monthly cost of your health insurance. But they're based primarily on your income. So for example, there's certain ranges of income. Technically, it's adjusted gross income, but there's certain levels of income to where it's a sliding scale. If your income increases, you get less and less of these subsidies. That means your premiums are higher, closer and closer to the full cost. If your income is lower, then your subsidies increase. That means your health insurance cost is lower. And this is where tax planning is really important, because If your income is rising too much and we're not doing anything to bring that taxable income down, so using deductions, pre-tax contributions to retirement accounts, things like that, then we can all of a sudden start to increase the cost for your health insurance. If we're really careful about that, if we're really careful about the tax planning side of that, then we can plan around these health insurance and make the most of these subsidies. So that's a really important area, is figuring out what health insurance makes sense for the family. And then how do we plan around these health insurance subsidies? Because it's essentially another tax if you're qualifying for that. So that's a really important part of that. One other thing I'll throw in, and I'll get your thoughts on, or feedback on this, Eric, is that for student loan purposes, it may make sense for the borrowers to, if you're married, to file taxes separately. If that's the case, unfortunately, you don't qualify for these subsidies. So the way that you file taxes plays a part in that as well.
Gotcha. Okay, so item number 2 here, y'all, is going to be health insurance, right? So you're that emerging practice owner looking to cold start, looking to purchase a practice. Hey, want to be sure that household cash flow is in order. And number 2, health insurance. Evon, I really like how the first thing you touched on was to truly understand what healthcare consumption is in the household. Truly, what are the care needs? I think it's really important that folks are honest about that stuff, right? I mean, you know, in some instances, it may be, do you need all that coverage you're going for? But in other instances, it's perhaps not getting the type of coverage that really is in the best interest of the family. To your point, Evon, a really simple exercise to do, and I remember when we did it when myself just a few years ago, right? Is understand, what are those ongoing healthcare needs, right? What doctors are being seen? Are there medications? Are there treatments? Certainly across the board, understanding that. Also, we're in the eye care space. Eyeglasses and contact lenses, right? Think of anything that would go through any sort of, qualified health and savings vehicle, the whole world of opportunity there. Then I like how you pivoted over and you touched on this, the subsidies and the tax credits. Mm-hmm. And I was actually recently reading a blog about that, Evon, and it is a vast and oft overlooked area to capitalize on some pieces there. So really, really great stuff. So we touched on cash flow. We touched on health insurance. We're connecting with the one and only Evon Mendrin, talking about some of the top financial questions that he's getting from emerging practice owners that are cold starting, purchasing a practice. Evon, what is item number 3 on the list?
One thing I'll say on health insurance before I move on to item 3 is that,
sure.
I mentioned that it's sort of these subsidies are based on this sliding scale based on your income and a few other things. But starting next year, so 2026 and beyond, a hard cliff is coming back, meaning where right now, if your income goes up, you phase out little by little of these subsidies. But before, in the past and starting next year, once your income gets to a certain threshold, you lose it altogether. It's a cliff. So if you're $1 over this threshold, you lose the subsidy. So it gets more important next year and beyond, because you need to be much more careful about where your income is relative to these thresholds. But reach out if anyone has any questions. I know I'm being kind of vague about this, but there's a lot of details that goes into it. The next thing to think about is the next question I get is, when do you add a retirement plan to the practice? And to me, this is all about cash flow. So especially if you're a cold start, if you have enough cash flow to where you can contribute more than the IRA limits each year, so it's about $7,000 per person if you're married, $7,000 per spouse, and you have enough liquidity, like you've got good savings built up and you still have more cash flow, then you can look at something like a retirement plan in the practice. I think that makes sense because you can actually use it. You have the cash flow to put it to use. The other side of that is recruiting and retaining good employees. So if your employees are demanding it, like they are wanting it, then that's part of that decision too. So there's a business planning aspect of that as well. So, it comes down to cash flow and then what are employees demanding. And it often comes down to 2 choices. It's either a simple IRA plan or it's a 401k plan. And very often owners are are skewing towards the simple IRA in the early years because there tends to be no administrative costs. They end up making it up because you have to use those companies' funds, and the administration's all on you, the owner. So, when you have to spend a lot of time fixing stuff, that can get expensive too. One thing I'll say about that is that at some point, often earlier than you expect, the practice owner outgrows the limits on the simple IRA plan, and the 401k ends up being a better fit, plus some of the features that are included in the 401k plan and investing schedules. So, and another thing I'll add is that there are tax credits right now that will offset all of, if not most of, if not all of, the administrative costs in the first few years for a 401k plan, as well as the matching contributions. So from a cost perspective, after those tax credits, it ends up just being a moot point. And there are now a lot of pretty low cost, really reasonable cost 401k plan providers and plan administrators that focus on smaller to medium-sized businesses like optometry practices. So the historic massive costs that used to come with 401k plans aren't necessarily the case anymore. So
sure.
That being the case, I do tend to lean towards starting the 401k plan from the beginning, because those tax credits eat away any of those costs anyways. And so, but that's usually the decision. It usually comes down to the cash flow of the business and the household and the demands of the employees. And then we're deciding between two general options there.
Yeah. That's some really great insights there, Evon, regarding, again, this item of retirement, right? As a new cold start, as a recently, if you've acquired a practice or looking to acquire a practice, and you're thinking, okay, what do we do benefit wise? It's all about cash flow, right? And I think, Evon, something that I do want to point out for the listeners out there that are on the cold start journey, you're going to be making those first hires coming into your practice. There's a couple of things you want to be sure that you're touching on. Number one, when you're accounting for how much your people are going to cost you, be sure that you load the salary, right? So if you're going to, somehow base this benchmark of a salary, maybe it's where you are now, you'll use that wage as the starter wage you're going to pay your team, right? But look, you're a brand new cold start.
Yeah.
You really got to understand all the ins and outs. So you're going to want to load that wage. And what does that mean? You take that hourly or yearly salary, and you want to be sure you're accounting for any sort of payroll taxes and your sort of insurances, your workers' comp. Also, that's where you can account for benefits. So we always advise, and we actually build it into our models on the front end, right? As we're building the team, let's create in that master budget the funds to be able to pay that. Now, the other thing to note, do not feel obliged to be offering benefits immediately as a brand new cold start.
Yes.
It's vitally important that you protect your business. Look, if you've got enough going for you as being a new business, seeking out and making those first new hires of being people that want to be a part of something new, right? They want to be a part of this, to be a part of creating something. That's what type of value you bring to them, and trusting that as the business grows, everyone will grow and win. So it's so vitally important that A, you structure it into your financial planning for your cold start, but B, you don't offer it. You strategically place employment opportunities, and with the hiring and onboarding, you're very strategic in how you do it. If you'd like to unpack that, we get some great resources, or we can hop on the horn. Evon,
one thing I'll add to that is that one question I was asked almost out of guilt by someone preparing for their cold start is it okay that we stop saving for retirement? And while if you have a spouse that is working and they have a company match, at least get the company match. There's some things I would say you make sure you're getting that, but in general, absolutely, it's okay that you are pausing your contributions to retirement accounts and investment accounts. The reason why is because your efforts of building this cold start is investing into a pretty substantial asset. And you don't see that, like you don't see dollars flowing to an account like you would. You can't calculate the savings rate, but you are still investing into this important asset. It may not be a retirement account, but it is an important asset, and it's success. So your practice's success is the thing that will fuel everything else. So your entire focus has to be in investing dollars and effort and time and energy into this business, this asset. And as cash flow allows, then you can take that cash flow and invest in other assets. But it's okay. You don't need to feel guilty about that. You're still investing in something.
Yeah. Yeah. But to build on that, Evon, would you recommend that you want to be sure, though, that when you do start paying yourself, set it up that a little bit is going, right? Like don't get to this whole, living high on the hog, driving fancy cars, buying boats. Like, be sure you're funding that retirement pretty promptly as your income is starting to increase.
Absolutely. Yes, definitely.
Good stuff. All right. So, you had something more to add on that front?
No. We can go to number 4. Yeah, I think we're ready.
Cool. Awesome. So on that note, number 4.
Yeah, number 4 is, how does my business entity work? And a lot of the times that question comes from a tax perspective. Just not understand like how the business is taxed. Like they see a business tax return. Is my business paying the tax? Am I paying the tax? Like what's happening here? And this is with cold starts. This is with practice owners who have owned their business for 7 years. I've been able to take that opportunity to educate, which is fun for me. And so, one thing to just kind of understand about that, and I'll speak really generally, is that there's 2 things to think about. Number 1 is the legal entity of your business, which can be, very often it's going to be a professional corporation in some states like California. It may be an LLC in other states. In some states like Texas, I've seen a PA, which I forget what that even stands for. But most of the time it's going to be an LLC, or in some states a corporation. So that's the legal entity. And then separately is how that entity is taxed. And that is split into sort of 2 general camps. Number 1 is the corporation. And a corporation, the corporation itself pays its own tax. So it's its own tax-paying entity. And then if you were to distribute dollars to yourself as a dividend, those dividends would then be taxed on your tax return. So there's 2 layers of taxation happening there. Most of the time, practices are going to be taxed as what's called a pass-through business entity, meaning all of the income from the business, all of the profit, is going to flow through to your tax return. There's only one place where all of this income is going to be taxed, and that's going to be on your tax return. And it may show up as wages that you pay yourself, and it may show up as just profit, business profit on the tax return. And so when you think about like the election, the choice of how your business is taxed, you can have an LLC. By default, if it's one owner, that LLC is going to be taxed as a sole proprietorship. The same way as if you didn't have an entity at all, didn't have an LLC at all. Sure. If there's more than one owner, then it's going to be taxed as a partnership. But your LLC can choose to be taxed as what's called an S corporation. And in that case, the business files its own tax return, but it doesn't pay its own tax. It's just for informational purposes. You pay yourself a wage, so your wage shows up on your tax return, and all of the business profit shows up on your tax return. So it all shows up on your own tax return. There's only one place it's taxed. A corporation, similar. A corporation can be taxed as a corporation, like I talked about. That's how all publicly traded stocks are taxed. Or your corporation very likely is going to choose to be taxed as an S corporation. In that case, you'll have a wage, and then you'll have business profit show up on your tax return. So there's some confusion around how that works. My business is filing a tax return. Is it paying tax, and so on and so forth. There's some nuances around state taxes recently, but I'll leave it at the federal tax level. But that's kind of generally what you'd see. Eric, any follow-up, any thoughts, questions on that?
The most important thing in that regard is, one, from an optometry standpoint, that you're incorporated the proper way from a legal standpoint, right?
Yes.
Like, don't be doing no legal Zoom with your optometry practice. Work with an attorney that's going to get you set up properly with the laws of your state. Then from the tax piece, Evon, it's where we say work with a CPA.
Yes, please.
I mean, really, we can have, even right here, we can have some really great conversations about this stuff. But Evon, I'm sure you're with me. Like, that's where I look at this stuff. It's like, that's the CPA question. That's why you have a good CPA.
There's two separate questions. Yeah. Two separate questions require two professionals. The legal entity in your state is an attorney discussion. Please talk to an attorney. Please do not throw your legal questions onto Facebook groups and believe you're going to get a reliable answer. Pay an attorney for their time to make sure it's done correctly, depending on your state. And then separately, from a tax perspective, talks to your tax professional about what election needs to be made, if any. And that can change over time. So for example, I may project out taxes each and every year, but I have to bring in that tax professional to say, this is what's going on. Do we need to make any adjustments here? And so you have to have a good tax professional in your corner. And if you need referrals, let us know. Eric and I, I'm sure, have great people to refer over to you. So
absolutely. Well, Evon, let me ask you, have you made elections? And if so, was it your call, or did you get a call for your CPA that said, hey, Evon, we need to change your election?
I didn't make an election. It was my call, because I know the triggers where I need to reach out to someone.
Sure.
That's a little bit different, but I know my situation really well.
Yes. Understood. Me, on the other hand, I've got a great CPA that I trust is going to tell me the right thing to do. And it's been working out pretty darn marvelous, right? Yeah. It's all about knowing what to do and having the right team to get it done, and done it right the first time. So piece number 4, and again, Evon, I suppose the other thought with that is, from the taxation standpoint, gets back to other things we've touched on. And that is, when you get back to health insurance, ways that are we sure that we're maximizing tax benefits there? We touched on the retirement piece, tax benefits there, right? That all plays into this whole context also. Maximizing the opportunity from the wealth planning standpoint.
That's right.
And that's where it ties back to, and again, like kicking off this episode, wealth planning being this holistic, integrative approach to the big picture and all the moving parts. So Evon, we've touched on 4, but I believe the title of this episode being 5.
That's
not
right.
4, but 5 financial questions for ODs looking to cold start or purchase a practice. Thus far, we have touched on cash flow, household cash flow. How are we going to make that work when our paycheck maybe taking a little hit for a few years? Item number 2, then we jumped into health insurance and ways to maximize some subsidies and credits that are out there, before jumping into number 3, and it's all about retirement in the practice and in personal savings. 4, we just touched on, and that is entity and taxation. And now number 5, what you got?
Number 5 is how do we make sense of these financial statements in the practice? And related to that is, what do we do with cash flow in the practice? And the owner's understanding of this, as we talked about, is directly correlated to the quality of the team around them. If they have a great consultant, if they have a great accountant, they have a much better understanding of these things. And so it's really looking at the details and making decisions. But for a lot of times, it's just we're trying to educate to see, what are the 3 major financial statements in your practice? What are they saying to you? And then how do we project out the near future and make decisions around cash flow? And when you think about cash flow, there's really 4 decisions. I mean, there's really only 4 decisions you can make. Being the owner of the business, one of the most important jobs that you have is deciding what to do with cash in the business, what to do with the resources of the business. And there's 4 decisions to make. You're either going to reinvest it back into the practice operations. So new equipment or technology, new exam lanes, hiring and training, perhaps inventory. You're reinvesting it back into the current operations, number one. Number two is you're expanding. You're going to purchase another practice. You're going to cold start another location. Now, that opens up another can of worms. Are you really wanting to do that? Are you really wanting to expand in that way? Number three is pay down debts. You can pay down debt in the practice. You can increase the owner's equity, so your equity in the practice, or you can distribute. Number four, distribute cash to yourself. And so understanding what is going on financially in the business, having a bookkeeping platform or software that actually gathers this data and making sure it's done accurately on an ongoing basis, and then making decisions. I mean, those are critically important to the success of your business and the success of your family financially.
Yeah, absolutely. And the whole world of practice financials, Evon, as we've touched on, I think in other episodes that you've joined us, and I've done some writings about it. And that is, particularly we're looking at the expense side of things and these expense benchmarks. Those dollars go straight to the bottom line.
Yeah.
Right. So when you're monitoring your metrics and you're able to see month to month how stuff's moving, and then you're knowing where to go dig in and assess statements, get with whoever's making decisions in the practice. I mean, something we see quite frequently is cost of goods sold, right? I mean, especially anytime post-show season, right? I mean, COGS
That's
go
right.
up.
Yeah.
Is it always in the best interest of the practice? Who is making those decisions? How are they making those decisions? I mean, holy cow, Evon, you said you didn't put these in any sort of order, but you clearly saved, I believe, one of the most emphatic things in the context of everything. Although all of these have been very, very important, but in the context of practice financials, that also, I think, lends itself to, seeing as we're speaking to this episode through the lens of the cold start or the newly acquired practice, and that is the master budget. And I think that is a theme that we realize as we kind of wrap things up. This all ties back to understanding your numbers, having the budget in the business, in your household, and then being really proactive with the decisions you can make, and be building wealth and planning for wealth, even as a brand new cold start or a brand new practice owner. Evon, I'd love to pass it over to you for just kind of some closing thoughts and remarks around this.
Yeah, one last thought I'll add to this, and I wish we had another hour to go through the financial statements to really dive in more. I think you and I have both done content around that. So for the listener, check out our content around the financial statements. Reach out to Eric, reach out to me. But there is a difference between profit and cash flow. And what you see on the P&L is not always a perfect indication of the actual cash flow available on a month-to-month or yearly basis. There are times where you have debt payments in the practice that are the principal portion of that's not accounted for on the P&L. Oh my goodness. There are expenses, depreciation expenses on the profit and loss that are not real cash expenses. So the cash flow and the profit are not always going to line up together. You want to have a good feel for the expenses or the outflows of cash that don't show up on the profit and loss. But any other final thoughts? I mean, it starts, to me, and my flow here kind of started with understanding the finances of the household so that your business has a long enough runway, and ended with understanding the finances of the practice, because a financially healthy practice, and what Eric would help anybody with, is an operationally healthy practice, is going to lead to success in the personal finances. The success of the practice feeds everything else. It feeds your ability to sustain the lifestyle that you are aiming for. It sustains your ability to then reinvest into other things and build towards stuff like financial independence. So the health of the practice can't be ignored. And all of this stuff kind of has to be looked at together. So if anyone has any questions, you can go to my website there. I think that's showing up there. Optometrywealth.com. Reach out to me, schedule a call, check out all of the resources and articles and stuff we put out there. A really easy way to follow along is to go to our podcast, the Optometry Monday podcast. We put out episodes on all these different things.
Yeah. And as a matter of fact, Yvonne, I'm glad you referenced the podcast because y'all, a lot of what we've touched on in this episode, Yvonne has got some really great deep dives into each one of these areas. And I think to as we kind of wrap up here, if you've been tuning into this content, different episodes where Yvonne's been joining me and you're really plugged into taking ownership and being proactive in your wealth planning, reach out to Yvonne. Absolutely. Head on over to optometrywealth.com. Book a call with Evon. It's really fascinating. You will be shocked at what you'll have the opportunity to do. Truly, no matter where you are in your career right now, particularly in this journey, cold starting or purchasing a practice, there's definitely things you can do to get proactive in growing your long-term wealth. So to that end, Yvonne, I want to again thank you so much for joining us on this episode of Akrinos Access and sharing all those great insights around some of these top financial questions that you're hearing from optometrists that are cold starting and purchasing a practice. Y'all be sure to connect with Yvonne over at optometrywealth.com. If you're a listener, you absolutely want to subscribe to the Optometry Money Podcast. And no matter where you are in that journey, man, go get it. Make it happen. Cold starting that practice, purchasing that practice, and know the team here at Akrinos is here to help you every step of the way. So until we connect with you again on down the line, Eric Matei signing off for Akrinos Access.